let's get into it because we're going to begin with our stock of the day. Now, it is one of those ones that have reported today. Credit Corp reporting record full-year earnings of $106 million. That's up 12% on the prior year. Earnings per share at $1.55, with the board declaring a dividend of 77.5 cents. That's an increase of 14%. The company also citing growth in its legal debt collections, which surged 36% in the final reporting quarter as a major driver of the results. And the company's US debt buying operations delivered a strong performance, contributing $26 million to net profit. An expected net profit of between 110 and 118 million for FY27. Now, earlier I caught up with the Chief Executive, Thomas Beregi, who spoke about the company's M&A strategy following that failed bid for Hum.
An offer that was rejected, so we still have an interest in that business and an interest in expanding into point of sale lending. So from our perspective, it's not off the table, but it's a reasonably complicated situation. There's obviously a board there. There's also a major shareholder who appears to be increasing his holding as well. So maybe that becomes increasingly difficult as an option for us.
So Luke, let's start with you. Thoughts off the back of those numbers you saw today?
Yeah, so, market hates the idea of that home acquisition, and I think with good reason. Don't really rate that as a business personally, never kind of have. Don't know why business of Credit Corp's quality and with their addressable market in front of them really need to be pursuing a low quality acquisition like Hum. In terms of the result today, if you read this result on kind of face value, you'll say, okay, well, this is a great result. Business is doing what it's supposed to do, and they are. Credit Corp, though, is really about their ability to buy these debt ledgers, in particular in the US, where they're trying to establish themselves as a bigger business and take more market share. And their ability to buy these debt ledgers, essentially people with bad debts from banks or motor vehicles or whatever the case may be, they say, look, that debt's worth $100, we'll buy it off you for 10, 20, 30, and then hopefully they can go and collect more than 10, 20 or $30 depending on how much they've paid for it. So their business model is quite simple, but the debt ledger buying is a lead indicator for future earnings, and the market was kind of expecting kind of 180 million, 200 million bucks spent on US debt ledgers as the guidance, and the company's kind of come out and said, oh look, we're only going to spend 130 odd million bucks. So that's kind of why the share price is down kind of 5-10% today. It's on the back of the fact that people are sort of looking at that buying and saying, well, what's the return on average that Credit Corp are going to get on that kind of money? Well, that's a little bit below where our earnings expectations were. So I personally don't see it as a huge issue. Credit Corp in the past have come out kind of mid-year and bought debt ledgers sort of opportunistically, shall we say, and they do have a pretty strict kind of return on equity, return on invested capital type framework, in which they buy these debt ledgers, and they're only willing to pay so much and take so much risk on, which I think is disciplined and sensible, particularly in they've been in the US for a few years now, but they're not as au fait with that market, and they are also expanding into the UK. So look, I think Credit Corp on 8 times earnings a reasonable buy here. You will get a cyclical uplift from previous PDL buying, I think, in FY27. And there is always that sort of chance that they do sort of come across a couple of deals and are able to sort of expand that buying because they do have the cash to do that. So look, it'd be a buy from me. Good business, trading at a really low price, and with sort of blue sky optionality and upside, I think, in the medium term.
Okay, that is a positive view then. Mark, do you share that?
Yeah, surprisingly, I haven't been that positive on this in the past, but and the share price just drifting low has kind of justified that. But I mean, what were people expecting? I mean, they're by their very nature, they're guiding conservatively, and not obviously giving that guidance around that 150 plus mil. Region realistically would be the justification for a 10% sell-off. Had to be a 15 to 25 PE, but it's not. It's an 8 PE, and I think that overall you've got that K-shaped economy thing going on in the US, and I think there'll be some worker displacement, things like that. I think there'll be credit books out there, that they'll be able to acquire. They did say that it was getting a little bit harder to acquire some over there, but look, I think it's just a case of the company, like I said, by its very nature, being pretty conservative on the guidance rather than just being over bullish, and I think Luke's right. They've got a history of coming through and finding something in the meantime. So I like companies that underpromise and overdeliver. It's I think it's worse when it's the other way around, to be honest. I'd probably be starting to take a little bit of a nibble here. I mean, it's so hard to get dividends, and it's a real issue on the ASX at the moment. I think the ASX 200 is about 3% average, or 3.3 or something like that. I mean, this is 5.6 and really steady, and then you're getting at a discount today after a 57% record earnings. So, record profit and US earnings up 57%. So I think the market's got it wrong here. I'd call it a buy as well.
That is a double buy for our stock of the day, Credit Corp.